Nigeria's Treasury bill market saw an aggressive surge in investors' appetite at the latest primary market auction, with total bid soaring 4.59 trillion naira, nearly 3 times the 1.15 trillion naira offered by the Debt Management Office. Welcome to Business Points, where we extract the Nigerian economy and the government policies. I am Kike Lomo Okere. The auction, which was held this week, underscores intense liquidity in the financial system and a growing preference for government-backed risk-free assets. Despite the heavy demand, the DMO kept borrowing in check, allotting 952.60 billion naira across the 91-day, 182-day, and 364-day tenors. The clear winners was the 364-day bill, which absorbed the bulk of investors' interest, giving the government room to cut yields. The 364-day Treasury bill attracted a massive 4.40 trillion naira in subscription against an offer of 800 billion naira. The Debt Management Office allotted 808.78 billion naira, pushing the stop rate down sharply to 16.99%, a 137 basis point drop from January 18.6%. By contrast, shorter tenor recorded weaker demand, with 182-day bills with 123.41 billion naira in subscription against a 200 billion offers, with 80.61 billion naira allotted to 16.65% unchanged. 91 bills with 66.05 billion naira in bid versus a 150 billion naira offer with 63.21 billion naira allotted at 15.84%, also unchanged. This reveals that investors' demand is increasingly concentrated on longer dated instruments as market players move to lock in yield amid expectation of easing rates and persistent system liquidity. The underperformance of the 91-day and 182-day bills highlight reduced appetite for short-term placement. The strong oversubscription on the one-year paper strengthened the DMO's pricing power, enabling it to reduce borrowing costs without compromising demand. Analysis shows that the nearly 300% oversubscription confirms that excess liquidity continues to chase risk-free government securities, sidelining equities and higher risk assets. The sharp fall in the 364-day stop rate signals a shift towards a more issuer-friendly market, easing pressure on government financing while offering investors stable long-term returns. If this trend holds, Nigeria's domestic debt market may see lower yields on longer tenors, even as overall funding needs remain elevated. Nigeria is reaping the financial dividend of downstream petroleum sector reform, recording an estimated 6 trillion naira gain with the first 9 months of 2025, as food deregulation begins to reverse decades of import-driven losses. The Nigerian Midstream and Downstream Petroleum Regulatory Authority says the gains reflect a structural shift away from costly fuel import towards domestic refining, improved gas utilization, and adoption of Naira-based petroleum product transaction. Addressing participants at the Nigeria International Energy Summit in Abuja, the regulator confirmed that the downstream sector is steadily transitioning from a subsidy-distorted system to a market-driven industry capable of attracting long-term investment. The authority says Nigeria is now prioritizing 100% local supply of petroleum products, a move already easing pressure on foreign exchange and repositioning the energy sector from the net FX consumers to a potential FX earners. The reform are also reshaping the gas landscape. Natural gas is emerging as a core pillar of domestic energy supply and a platform for regional export under the federal government's Decades of Gas initiative. Policies are being rolled out to expand infrastructure, stimulate demand, and create a commercial viable gas market across value chain beyond export. The focusing is shifting to value addition. The regulator says Nigeria must move from exporting raw gas to becoming a regional hub for refined gas products, including urea, ammonia, and fertilizer, leveraging its vast reserves to deepen industrial growth. On regulations, the agency insists that investors' confidence deepen on discipline and strategic alignment. Projects will only be approved where commercial viability is clear and where they fit into Nigeria's long-term energy and economic plan. The authority also flagged infrastructure as a critical reform area, noting that inefficient road-based fuel distribution is no longer sustainable. A new pipeline-led strategy is being developed anchored around major refinery hubs such as Dangote and Port Harcourt to replace aging network and realign supply corridors. The 6 trillion naira gain signals that downstream deregulation is beginning to deliver measurable economic value, reduce import dependence, stronger FX conversion, and growing domestic refining capacity are reshaping Nigeria's energy economy. If infrastructure expansion and regulatory discipline are sustained, the downstream sector could evolve into major driver of investment, industrial growth, and foreign exchange earning. The federal government has sealed a cooperation agreement with the International Financial Corporation to accelerate development of bankable infrastructure projects and unlock private capital needed to drive Nigeria's economic transformation. The deal signed in Abuja brings together key economic ministries and the World Bank Group private sector arms in a coordinated push to close Nigeria's massive infrastructure gap through well-prepared investment-ready projects. Under the agreement, the focus will be on the strengthening project identification, structuring, and budget preparation across critical sectors, including transport, power, water, healthcare, and digital infrastructure. The goal is to move projects from concept to execution faster, with clear risk framework that gives private investors confidence. Government officials says the partnership aligned with President Bola Ahmed Tinubu's reform agenda, which prioritizes macroeconomic stability, policy predictability, and private sector-led growth under Agenda 2050. With a population exceeding 230 million, Nigerian infrastructure needs are vast, and public funding alone is no longer sufficient to meet demand. The IFC says the agreement, built on months of technical collaboration, is designed to improve quality, bankability, and delivery speed of high-impact projects. It also reinforced the role of public-private partnership as a center pillar of Nigerian development strategy. Beyond infrastructure, the partnership is expected to help translate ongoing economic reform into tangible growth outcomes, leveraging Nigeria's youth population and expanding markets to attract long-term investment. The FGIFC agreement signals a shift from ambition to execution by focusing on bankable projects rather than funding promises. The government is also positioning private capital as the engine of infrastructure delivery. If project preparation improves and reforms remain credible, Nigeria could unlock billions in long-term investment and accelerate economic growth without overburdening public finance. Nigeria economic activity strengthened again in January 2026 with the purchasing manager index rising to 55.7 points, marking the 14th straight month of expansion. The latest Central Bank of Nigeria PMI report shows broad-based growth across the industry, service and agricultural sector, reinforcing signs of sustained economic momentum at the start of the year. The industry sector led the expansion, posting 56.0 points, with 14 of 17 subsectors recording increased activities. Manufacturing, construction and related industry continue to show resilience, reflecting improving demand and production condition. The service sector maintained its upward trajectory for a 12th consecutive month, recording 54.5 points growth was widespread, with 12 out of 14 subsectors expanding, underscoring steady recovery in trade, transport and other service-related activities. The agriculture sector also remained firmly in expansion territory as 54.2 points, extending its growth run to 18 consecutive months. All 5 agricultural subsectors recorded growth, pointing to stable output across farming and agro-process activities. Overall, 31 out of 36 subsectors tracked in the survey expanded during the month, highlighting the depth and spread of economic activities. The CBN also noted easing price pressure, with input and output price indices moderating across composite, service and agriculture sector, offering some relief to businesses. The sustained rise in the PMI suggests Nigeria's economy is entering 2026 on a firmer footing, supported by broad-based sectoral growth and moderating price pressure. If inflation continues to ease and demand holds up, the expansion could translate into stronger output and improve business confidence in the months ahead. Net foreign exchange inflow into Nigeria declined sharply in the first 9 months of 2025, falling 18.3% year-on-year to $48.1 billion, as a weaker inflow outweighed the drop in the outflow. Central Bank of Nigeria data shows that total forex inflow fell to $83.71 billion, down from $99.44 billion a year earlier, while the outflow declined to $35.65 billion from $40.61 billion. The steeper fall inflow kept net supply under pressure. Flows through the CBN window recorded the sharpest decline. Inflow dropped by 30% to $28.72 billion, while outflow through the bank fell to 18.8% to $25.68 billion. This pushed net forex flow through the CBN down by steep 62% to $3.04 billion. Autonomous inflow also softened, slipping 6.8% to $54.99 billion, while outflow through autonomous sources rose 18% to $9.97 billion. As a result, net autonomous inflow declined by 11.5% to $45.02 billion, tightening overall market supply. Diaspora remittance added to the pressure inflow from international money transfer operator, which fell by 15.7% to $3.22 billion, with decline recorded in all 3 quarters of 2025. The sharpest drop came in the third quarter, when IMTO inflow slid 22% year-on-year, despite the weak 9-month performance. The third quarter provided some relief. Net forex inflow rose 20% quarter-on-quarter to $17.46 billion, reversing decline recorded in the first and second quarters. The rebound was driven largely by a sharp contraction in forex outflow rather than stronger inflows. Analysis shows that the data points to a sustained pressure on the Nigeria's foreign exchange supply, driven by weaker inflow from both official and autonomous sources, including diaspora remittance. While the third quarter rebound is a positive signal. It was largely outflow driven and may not be durable unless inflow recover. A sustained turnaround will depend on stronger capital inflow, improved export earning, and renewed confidence in the FX markets. All right, let's take a quick short break now. We'll be right back. Don't go away. Stay with us. Welcome back. If you're just joining us, it's Business Point, where we extract the Nigerian economy and the government policies. The Naira strengthened against the Euro on Thursday trading session, closing at 1,606 per Euro, up from 1,644 Naira per Euro the previous day, as buying pressure on the local currency intensified. Data from the Central Bank of Nigeria shows sustained momentum behind the Naira, driven by improving foreign exchange inflow, stronger external buffers, and tighter monetary conditions that continue to attract yield-seeking investors. The Naira's recent stability and gradual appreciation against major currencies, including the Euro and the US dollar, reflects a shift from years of steep depreciation. Nigeria's external reserve, now estimated at about $46.7 billion, have strengthened the CBN capacity to support the market and meet the FX demand. Monetary policy remained firmly restrictive. The CBN has kept interest rates elevated to sustain capital inflow and anchored inflation expectation, cutting its benchmark rate only once in 2025 by holding it at 27% since November. High yields on Naira assets continue to draw foreign portfolio investors, boosting demand for local currency. Trade dynamics are also working in Nigeria's favor. The countries maintain a strong trade surplus with the European Union, estimated at $10 billion in 2025, driven largely by export of crude oil, gas, cocoa, and related commodities. The European Union remains Nigeria's largest trading partner for both oil and non-oil exports, with countries such as Germany, Netherlands, Belgium, France, and Spain playing key roles. While Nigeria and the European Union have yet to finalize a full economic partnership agreement, trade continues under alternative frameworks with renewed commitments in early 2026 to deepen cooperation in trade, investment, digital economy, agriculture, security, and climate action. A Nigerian EU ministerial meeting is scheduled for Abuja in March 2026. On the other side, the euro faces growing headwinds. Eurozone inflation has eased to 1.7% below the EBC target, fueling expectation of potential rate cuts. Economic growth across the bloc remain modest, with 2026 growth projected at around 1.2%, limiting the euro upside. Policy debates within the EU are also intensifying. France has flagged concern about the euro's strength against the dollar, while broader discussions are underway on boosting the euro's global role and reducing dependence on US dollars. Analysis shows that the Naira's appreciation against the euro reflects a convergence of domestic strength and external weakness, strong reserve, tight monetary policy, and a favorable trade balance are supporting the local currency, while Eurozone growth and softer inflation cap euro gains. Sustaining the momentum will depend on continued FX inflow, disciplined policy, and stability in global markets. All right, before we call it a wrap, let's take a quick look at the stock market. The Nigerian Exchange Group and the Security and Exchange Commission and the Nigerian Police Force has intensified collaboration to safeguard investors' data, financial crime. and reinforce trust in nation's capital markets. The partnership was highlighted at a closing gong ceremony hosted by NGX, attended by Inspector General of Police Kayode Egbetokun and top SEC and NGX officials. The event underscores a unified commitment to coordinated enforcement, regulatory alignment, and robust market oversight. Leaders emphasize that market integrity is a shared responsibility. Strong collaboration between regulators, law enforcement, and market operators is essential to tackling illegal investment scheme, protecting investors, and building a credible, resilient financial system. NGX executives also stress that as technology-driven trading accelerates, enforcement and oversight framework must evolve in tandem. The Nigerian Police Force reaffirmed its role in supporting a transparent, well-regulated capital market, signaling that financial crime prevention is now a top priority for both regulators and the law enforcement. The SEC noted that aligning regulatory and enforcement action strengthens deterrence, enhance investors' confidence, and preserve trust across Nigeria's growing capital market. The ceremony brought together key stakeholders across the capital market ecosystem, marking a collective resolve to uphold accountability, transparency, and investors' protection. All right, this is where we'll call it a wrap on Business Point today. Join me again next time on Global Television, channel 365 on DSTV and 276 on Star Times. To remain connected, kindly follow us on all our social media platforms using @GlobalTVNG. Till I come your way again, I am Kike Lomo Okeri. I celebrate you all.